The cybersecurity industry has grown to generate hundreds of billions of dollars per year for many of these cybersecurity stocks. That's expected to continue for at least another decade, perhaps more, as more of our lives become online. Of course, I'm not too happy about that. Some of these cybersecurity measures do a better job of keeping me logged out of my systems than they do of keeping hackers out of the systems themselves. But that's besides the point. I'm not going to complain too much about my battles against cybersecurity logins. But what I'm going to do in this video is answer which one I think is the better cybersecurity stock to buy, Okta or Palo Alto Networks. I'm going to compare these two on revenue growth, cash flow from operations, operating profit margins, returns on invested capital. Then I'm going to look at valuation. I'm going to compare these two on the forward price to earnings ratios and compare them on a discounted cash flow valuation to determine which one I think is the better buy heading into 2025. Let's take a look. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. So looking at revenue growth, we notice Palo Alto Networks done a better job in this regard, growing revenue all the way up to $8.3 billion compared to Okta, which generated $2.533 billion. Although since 2022, Okta has also demonstrated solid growth. Palo Alto Networks also since 2022, pretty much steady growth for these cybersecurity stocks. There was a bit of a scare in late 2022. Well, I shouldn't say a scare. I should say a concern that started with Palo Alto Networks, actually, when the company said that it was going to take this strategy to gain market share. If you remember, I did several videos about this because I was concerned how it would impact the industry. Palo Alto Networks said it was going to offer a free trial to customers of other cybersecurity companies. If they had a contract, let's say, with a company for 3 years, Palo Alto Networks said that they would give that customer a free trial to Palo Alto Networks for the period that they had a contract signed with another provider. That strategy was aimed at stealing customers that would tell Palo Alto Networks sometimes, look, we would love to join you, but we already have a contract with another provider and we don't want to pay two companies. So Palo Alto's response was, fine, come join us and you don't have to pay us until that contract with your other company is completed. So that was a huge competitive decision that I don't think other companies were happy about because that's Palo Alto Networks trying to steal customers. And I was worried about the response, the trickling effect throughout the industry following that move. But thankfully, there wasn't a big response to that in 2024. The other rivals didn't make a move back against Palo Alto Networks, trying to hit them back for their competitive move, which is what usually happens when one company makes a move like that to try and take market share. So with that concern behind us, the cybersecurity industry heading into 2025 is in much better shape. All right, so now that we've looked at revenue, let's look at cash flow from operations to sales. And in this metric, we can see two different stories. Number one, we see Palo Alto Networks has a much better cash flow from operations to sales number at 39%, but its number has been declining. And partly because of that decision that I highlighted in the previous slide, right? That decision to let customers come on board without taking payment, without making payment, those free trials, that's going to hurt the company's cash flows and margins as it's serving a customer without getting paid for that service. Later on, it might pay off, but for now, it's going to be a hit to the company's margins as you're seeing already. Meanwhile, Okta has continued to improve its cash flow from operations, and while it's lower than Palo Alto Networks, it's improving, which is something desirable from investors like myself. I like to see improving trends. And we get a similar story with the operating profit margin. Although Palo Alto Networks' operating margin has not declined the way its cash flow has, it's actually continued to improve all the way up to 9%, up from negative 15% in 2015. Similar improvement with Okta, although better improvement. The slope is steeper on their improvement. but the number is worse at negative 5.41%, but that's up from negative 65% in 2022. So massive improvement here for Okta, although the number is still negative and the number is still more favorable for Palo Alto Networks. Return on invested capital shows a clear advantage for Palo Alto Networks at 47.77%. The company has done a great job of taking investor capital, investing it into products and services that generate profits for shareholders. Okta has been improving, although the number is still negative. It's up from negative 25% in 2020. It's made great strides, but Palo Alto Networks has made better strides in this regard. All right, so now that we've looked at these characteristics, let's look at valuation. And understandably, Palo Alto Networks is trading at a more expensive valuation because the company has achieved larger scale. It has the better cash flow margin. It has the better operating margin, the better ROIC. So you would expect it to be trading at a more expensive valuation. It's trading actually almost double the valuation of Okta at a forward PE of 52 compared to a forward PE of 28 for Okta. But that's just one way to look at a valuation. Another way is to do a discounted cash flow model and derive an intrinsic value per share and compare it against the market price, which I've done for both Okta and Palo Alto Networks relatively recently. This valuation was as of December 16th. And the intrinsic value per share I derived for Okta was $118 compared to the current market price, which is only $82. So significant undervaluation according to my discounted cash flow model for Okta. For Palo Alto Networks, this valuation I did a few weeks ago. Well, not a few weeks ago, I would say a week ago, and then I updated it today to include the impacts of the stock split. And so I added the number of shares outstanding because the number of shares outstanding increases when you do a stock split. And so the intrinsic value per share I got for Palo Alto Networks was $155, while the current market price was $190. So a overvaluation according to my calculations for Palo Alto Networks. So similar story I get from the valuation metrics, both on the forward PE and the discounted cash flow. The story I get is that Palo Alto Networks is more expensive than Okta, a lot more expensive than Okta. While I do agree it's the better business, I don't think it's earned that much of a premium valuation over Okta. So if I was to choose one of these heading into 2025, I would choose Okta as the better cybersecurity stock to buy. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.